Hey, what's up, everyone? Welcome back to Debt Free with Wesley. In this video, I'm going to illustrate how to pay off $20,000 of student loans within 14 months using the Velocity Banking method. So, before I go into that, I just want to show you the setup for this scenario. We've got a $20,000 student loan at 3.85%. It's a 20-year term, and our monthly payment is just a few cents under $120 per month. This individual has an income of $5,000 a month, expenses of $3,500, which includes that $120 payment, cash flow of $1,500, and they have a line of credit that is 12% interest. Okay, so if an individual were to just pay this student loan the traditional method, just making their monthly principal and interest payment of $119.62, in the first month they make that payment, $64.17 of the $119.62 goes to interest. The remainder goes to principal, and that brings our balance from $20,000 down to $19,944.55. Okay? Each month, the same thing will happen. They'll make their $119.62 payment. Each month, the interest cost will go down slightly because the interest is accumulating off of a smaller balance, and the principal will go up slightly. And this will continue for 20 years. All right, let's just fast forward to the end of year one. We've now gone from $20,000 to $19,322.68. Okay, so for this first year, this individual made $1,435.45 worth of payments. They paid $758 in interest for the year, and they reduced their principal by $677. So more than half of their payments went towards interest, right? Not really driving that balance down very much at all, right? So now let's look at how to pay this off using the velocity banking method. So if you're not familiar with it, the velocity banking method means you have a line of credit, you consolidate debts with that line of credit, you then deposit your income into that line of credit, all of it, and then you draw your expenses out of that line of credit as they come in. So what that does is it allows your income to suppress the balance throughout the course of the month, which reduces the amount of income that's accumulating on that debt. So the simplest way to put this is we're keeping our balances as low as possible for as long as possible by depositing our income into the line of credit as soon as we receive it, and then gradually drawing expenses out. And what happens is our monthly cash flow, in this scenario, $1,500, stays inside that line of credit, keeping that balance low and reducing the amount of interest that accumulates. Okay, so let me just go ahead and show you how this illustration plays out. So in month one, we started with a $20,000 balance on the credit line. Okay, this is going to assume that we paid off this student loan with the line of credit. So we still have the debt. It's just no longer in the form of a student loan. Now it's on the credit line, right? We then deposit our income. Over the course of the month, we subtract our expenses. The interest rate on this is 12%. So $200, that's the calculation on $20,000. And so our end of month balance is $18,700. Okay. So what that is we take negative 20,000 plus 5,000 minus 3,500 minus 200. That gives us our $18,700 number. Okay. We're going to repeat this process the following month. All right. And you can see that over the course of time, this balance is reducing quickly, right? Now, you might look at this and say, well, look at all that interest you're paying. Yes, we're paying a higher volume of interest because it's a much higher rate. But when we look at this on the large scale of things, okay, we pay off this entire $20,000 debt within 14 months. All right. With the normal payback period after 12 months, that loan wasn't anywhere close to being paid off. Whereas with the velocity banking method, we're going to pay off this loan entirely within 14 months. Okay. Now check this out. As a result of depositing our income into the line of credit, whatever minimum payment would have been due is going to be satisfied. Okay. So what actually happens is when we pay off this student loan, this $120 payment is eliminated entirely. All right. And because we're depositing our income into the line of credit, it's satisfying any monthly payment. So in reality, once we transfer that balance onto the line of credit, it's actually going to free up an additional $120 a month, which increases our cash flow, which is just going to put us into an even better situation in that payoff. Okay. So what ends up happening here, if we look at this, is over those 14 months, we paid a total of $1,455 of interest to pay off that loan within 14 months. All the while, we freed up $120 a month of cash flow. And after that 14 months, that loan is gone completely. Whereas with the traditional method, it would take us 20 years to pay that loan off, and we would have paid a total interest of $8,700. All right. So huge interest savings, even though it's a higher rate of interest, we're paying a much lower volume of interest as a result of paying that loan off so fast. All right. So hopefully this all made sense. If you have any questions, be sure to drop those questions in the comments. I'm happy to jump in and explain it to you. If you have a scenario of your own that you would like me to map out and make a video of, please just let me know and I'll get in contact with you, get all the information, and put together one of these videos for you. All right. So happy velocity banking to all of you watching this. I appreciate you watching, and we'll see you in the next video.